go straight to Brad McFadden from the Daily Trading Report founder. Brad, great to have you on board. Look, is it time to jump into US equities?
It sure is, and it's been that way for the last few months.
Okay,
and significant upside should be on the cards over the coming months.
Why the lag? Why the discrepancy?
Well, it's Europe. Simple as that. And look, the other thing too, which one must bear in mind, is that the GFC is still very, very much in the forefront of people's minds. So any slight hiccup in economic data coming out of not only the US, but also what's happening in Europe, and people are being running to for the covers, naturally assuming that there's a repeat of 2008. But I don't think it's going to happen.
But you can understand people might be a little bit gun-shy, I suppose. Particularly with this volatility, you might buy a stock at what you think is a great price, and 2 days later it falls about 4%.
Yeah, well, look, we have a very, very strange mood in the market right now. In fact, like the last few years, people become very, very short-term focused. They've lost sight of the good old-fashioned way of investing. That's, you buy a stock and you hold it for a couple of years. These days, it's like, what happens next week, or even like a month out is a long-term time frame.
Do you think post the global financial crisis, looking at historical price to earning ratios and so forth, or the other way that we used to, I suppose, decide whether or not a stock is attractive has become outdated, potentially moot, that we're in a new trading environment, and as such we have to look at new multiples?
You know what? That argument reminds me of the TMT bubble and the whole so-called new economy that was fed to us back then. No, this is no different than any other time in history. No different at all. And
yet we are still seeing that big move into, I suppose, sort of really defensive plays. I mean, you just have to look at US Treasuries. Indeed, some of them, you're actually losing money.
Yeah, well, look, the one of the most bizarre things right now is that Treasuries, or the valuation differential between Treasuries and equities, it's the same now as what it was back in the depths of 2008. And really, that sort of tops everything off, explaining what's going on. The yield differential is about 6%, and it got to about 7% in the global financial crisis in 2008. The only other time in the last 40 years it was at that level was at the end of the bear market in 1974. So the key issue here is not so much what's going on in Europe, but what's actually been priced into markets. And right now, asset prices globally, let's say Treasuries, equities, have been priced for a repeat of the global financial crisis.
I suppose on the metrics, it's understandable, I suppose, and you look at the Australian market, a similar story where there is certainly a fair degree of value compared to traditional asset price levels and so forth. But at the end of the day, the market still is an emotional beast. It drives a lot on psychology and so forth, and that, can you understand, would be driving markets as opposed to the fundamentals?
Well, yeah, I mean, in the short term, the markets are very, very much driven by emotions and greed and fear, but in the long term, fundamentals play out. So, again, everyone tends to, everyone's lost sight of the long-term fundamentals and the good old-fashioned way of investing.
Do you think that the latest reporting, the latest set of earnings from corporate America sort of backed up the bullish nature?
Yeah, completely. It's quite bizarre, quite ironic, bizarre, call it what you will. If we go back, 6 weeks before the earnings season started, analysts were being accused of being far too bullish. That's bottom-up analysts. Far too bullish on the prospects of earnings. And as it turns out, they've been far too bearish. Yeah, I mean, earnings have bet estimates by about 6% this quarter.
Hasn't a lot of it, though, been on cost cutting? There hasn't been an awful lot of top-line growth, and that has seen, those companies that have seen a lot of revenue growth and so forth, a lot of it has been derived from offshore interest, if you like, not so much what's happening domestically in the US.
Yeah, I mean, that is a factor. There has been revenue growth. Analysts have actually got that more or less right. But what they've failed to understand is that corporate America is a very, very different beast animal than what it was prior to 2008. The GFC caused a massive restructuring of both the costs and also gearing as well. So again, corporate America is a very, very different beast than what it was back in 2008. Now, look, we can talk about America and growth, etc., but you know, when you're talking of stocks in the US, let's talk Exxon, Disney, Walmart, what else? Procter & Gamble. These are not really US stocks, they're global stocks. So that's a key thing, not to get too carried away by the prospects of any one country, but we're talking stocks on a global scale here.
Look, Brad, just finally in terms of US stocks, is there a time limit in terms of the value that they offer at the moment? And if so, I mean, how much longer until we see that sustained bounce?
Well, I bring in...
It's a tough one.
Yeah, look, there's a little saying here I use from John B. Templeton, the famous value investor from the 50s, 60s and 70s. And that is, a bull market is born in pessimism, grows in skepticism, matures in optimism, and dies in euphoria. Now, when everyone starts doing the old happy clapper thing, that's the time to get out of equities. And it's far from that right now.
Brad McFadden, appreciate your time. Thanks a lot.
Thank you.